Good afternoon, everyone, and thank you for really taking the time out of your busy schedules to join our webinar today. My name is Anya, and I'm a financial advisor at Dunhill Financial. I'll be the moderator for today. We'll have two amazing guest speakers with us today. We'll be introducing them shortly. However, before I do that, I just want to take a moment to run through a couple housekeeping items. First, please note that we'll be recording today's session and we'll be putting everyone on mute until the Q&A session at the end. Feel free to ask any questions in the chat and we'll answer them during the presentation whenever possible. We also have time set aside for Q&A at the end. Also, I have a few disclaimers to go through for compliance reasons, so just bear with me as I go through that. Information presented today is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, they're not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed today. So now let's begin. Today, our speakers will discuss tax filing updates primarily for Americans living in Germany and the Netherlands. And with us, we have Nathalie Goldstein from MyExpatTaxes, as well as David Bellingham from Black Swan Capital. First, Nathalie is an expat expert, EA, and founder and CEO of MyExpatTaxes, the leading US expat tax software. Originally from California, Nathalie was previously Chief of Global Solution Support at Cisco before moving to live as an expat in Europe and subsequently founding MyExpatTaxes in 2018. So welcome, Nathalie.
Thank you.
Yeah. And then our other guest, David Bellingham, is the CEO and director of Black Swan Capital. He's been advising international clients and heading up financial services businesses for over 20 years across 3 continents since he commenced as a financial advisor in the 1990s. He has a Bachelor of Applied Science, a Master of Business Administration, a Diploma in Financial Planning, and a Graduate Diploma in Certified Financial Planning. He's a member of the Chartered Institute for Securities and Investments. So again, welcome Nathalie and David, and I'll turn it over to you to begin the session.
Perfect. Thank you so much for that introduction. I'll go ahead and share some slides now. So let me get that going. And just to make sure everyone can see the slides.
Yes.
All right. Perfect. So as Anya said, I'm Nathalie. I won't go through all of this slide again, but just so you know, I am an expat just like you. I am from the US. I moved to Vienna, Austria, close to Germany, not quite Germany, but close enough. And essentially, when I moved abroad, I just found that there weren't good solutions for US expat tax filing. Of course, there were a lot of boutique firms. However, those can be a bit pricey. And if you tried any of the US-based tax softwares, such as TurboTax, et cetera, you probably ended up getting very frustrated like I did, just because it's not really meant for an expat and it's not specialized to do so. And that's why we created MyExpatTaxes, a tax software that really makes it easy to file as a US expat abroad and also connects you to certified tax professionals that know exactly what it's like to be an expat and how to do expat taxes. So from there, let's think about what we'll talk about today. So the main things is obviously just general expat tax 101. We can always use a refresher on those. FBAR and FATCA. So aside from just your annual US tax filing, what else do you have to file? Because there's always a little bit more to know, a little bit more things to be aware of. And of course, as we're with Dunhill, a little bit more on foreign investments and pensions. Right? Obviously, just very short, brief notes about what to be aware of when you're planning these things. And David will be helping me kind of add more light to those topics. And obviously, what expat tax benefits there are to take on your tax return. And obviously, in the new filing year, since it's February, there's a couple of differences for this year, a lot of refund increases, which are good to know. But also, as we move away from the pandemic, a lot of things are removed from our tax return that we might have been familiar with in the past years. So I jump into the general question of who needs to file your US taxes. So it's a very broad net, essentially all US citizens or US green card holders that pass the filing requirements. And I'll show the filing requirements very shortly in the next slide. I just want to call out that one thing a lot of people don't understand is that even if you're a US green card holder and you give up your green card, right, you abandon it or you let it expire, it doesn't necessarily mean that you're no longer required to file a US tax return. If you don't give up your green card properly via Form I-407 and you don't file a final tax return saying that you're ending your tax residency, you're still on the hook like every other US citizen to file your taxes annually. So that's a pretty big call out because we have a lot of green card holders that say, I haven't been in the US for 10 years, my green card expired. But until you fulfill those kind of ending requirements, you're still on the hook. So with that being said, when we think about the filing requirements, the main thing is, what is your worldwide income? It's not about your US income, it's about your worldwide income. So income from all sources, right? And it's the gross amount, not anything after deductions or taxes. So really all income from all sources, gross amount before deductions. So that could be a salary from a German company, pension from a German fund, plus social security benefits from the US, all of that grouped together, the gross amounts. That is what constitutes worldwide income. And then even if you don't meet the filing requirements, which we'll go through, you might still want to file a tax return, but we'll get into why later, mainly to get, obviously refunds. And another thing is, a question we get a lot is, does it matter how old you are? Does that trigger a filing requirement? So age is actually not a major factor. I know a lot of parents especially ask, oh, my child is now 18. Do they have to file a US tax return? Turning 18 does not make you have to file a US tax return. It's always dependent on your worldwide income and if you pass the filing requirements. Obviously, if you are 65 or over, the filing requirements will increase slightly from what I'm about to show you. It's not significant. It just increases a little bit. And then another thing to watch out with, obviously, because we're all kind of investment minded here, is if you do have children and you do open kind of investment accounts for them, you do have to be wary that if they have unearned income, so unearned income is mostly investment income or any type of income that's not salary, compensation, self-employment income, if they have over $1,150, you might either have to report their income on your tax return or they might even have to file their own tax return. So again, when we think about who has to file a US tax return, the number one thing is basically any US citizen or US green card holder if your worldwide income is over the filing requirement. And I'll show you that in the next slide, but one thing I want to call out is it is in your US passport. That's a screenshot at the very bottom. So if you were to flip at the back of your US passport, you've actually been told ever since you got your passport that even if you move abroad, you're still on the hook to file US taxes. So with that being said, these are the filing thresholds for this calendar year, 2023, for your 2022 tax return. Remember, we're always filing the prior year in the current year. So a little confusing, but again, in calendar year 2023, we're filing our 2022 tax return. So the filing thresholds are mostly aligned to the standard deduction, as you will probably notice. The only thing to call out here is obviously married filing separately has a very low filing threshold. So married filing separately is a very common filing status for expats because essentially if you moved abroad, say for love, and you married someone that's not a US citizen, I'm sure you've probably asked them, hey, do you want to be on my US tax return? And their answer was absolutely not. And I don't blame them for it. If that is the case, though, you're probably married filing separately because you can't file as single, you're married, but you can't file with them. So you're married filing separately. Unless in the case that you have a qualifying dependent and you could go for head of household, most expats married to a non-US citizen will be married filing separately. And in that event, you have to file a tax return if your worldwide income is over $5. It's super low. It's been that way since 2018 and it hasn't moved a single dollar since. So that's just something to be very aware of. Obviously, the standard deduction for married filing separate is the same as single, which is $12,950 for this tax year, but the filing threshold is significantly lower. So that is something to watch out for. Another thing that's not on the screen is in the event that you're self-employed. If you're self-employed, even if that's not your main, kind of source of income, if you have any type of self-employment income and you have over $400 in net profit that would show on Schedule C, technically, of your tax return, you must legally file a US tax return because there might be some type of self-employment tax applied to your return. So just keep that in mind, right? Normally filing thresholds are aligned to the standard deduction, except for the case of married filing separately. And if you are self-employed and you have over $400 in net profit, you still have to file a tax return, even if you don't meet the filing threshold otherwise. So that was your US tax return, right? That is what you filed to the IRS. Now, there's a couple other things to be aware of. So I'm sure everyone knows about FATCA and, all the buzz that went around about, foreign banks closing the bank accounts of US citizens, right? I know this was mainly a thing in France, but obviously in Germany, Netherlands, it's happened, right? Where you get a letter from your German bank saying, hey, you have to come in, you have to give us your social security number, or when you open a bank account in the Netherlands and they find out that you're a US citizen, they have like this stack of papers for you to sign and basically to give consent that the US Treasury can look at your bank account abroad. So that's FATCA. It's essentially a double reporting requirement. So any foreign financial institution that wants to do business with the US, they have to comply. Where if they have any US citizens, accounts on file, they have to report that information to the US Treasury. Now, on the flip side of that, as a US taxpayer, you also have to report that same information to the US Treasury. So there's two forms to report that information, and the information is generally, honestly, very basic. It's where's your account located, what's the account number, and how much was the maximum balance in those accounts. Obviously intrusive, but pretty basic. There's no tax that's actually calculated from the bank accounts. It's purely informational. However, you do have to report this information on two forms. So the first of those forms is the FBAR. I think most people are very familiar with that form. And you have to report your bank accounts or any other foreign financial accounts. So that includes investment accounts, brokerage accounts, pension accounts, any foreign financial account, really. On the FBAR, if the combined max balance of all your foreign financial accounts is over 10,000 US dollars. So it's not the beginning balance, it's not the ending balance, it's not the average, it's the maximum balance. So that number can be a little bit hard to find, I know, because banks don't normally report that to you. What I do suggest is to look at monthly statements for your max balance, right? That should be the easiest way. Otherwise, obviously, you can always, get out your annual transcript of all your transactions and try to really figure out to the penny the maximum balance. However, monthly statements should be sufficient. Now, if you have over 200,000 US dollars on the last day of the tax year, or 300K at any other time during the year, keeping in mind this is for an expat living abroad and for someone that's filing single. So if you're married, filing jointly, the amounts are doubled. You have to then file the extended version of the FBAR, which is Form 8938. It's basically the same information, just a couple more questions, such as what did you open the bank account in this year? Did you close it? Et cetera, et cetera. So things to keep in mind here is the FBAR does not go to the IRS. Do not send your FBAR to the IRS with your tax return. That actually goes to, the US Treasury, specifically FinCEN, which is the Financial Crimes Enforcement Network. They have their own portal for you to submit a FBAR to. And Form 8938, if you do have to file, that does go to the IRS. That should be included in your US tax return. So obviously, it can be a little bit complicated to make sure everything is in order. That's why I highly recommend that either, obviously if you do your taxes yourself, be aware of this. If you're using a tax software, make sure it's one that's specialized for expats, because basically any US-based tax software will completely ignore the FBAR, which is not good since there's a penalty on the FBAR of up to $10,000 if you don't file on time. The same for Form 8938. And if you use, any type of tax firm or CPA, just make sure that they understand that these are additional filing requirements that you have to adhere to. So that's kind of everything you have to file annually. Now we jump a little bit more into the interesting topics of investments. I won't give you the interesting piece. David will do that, right? But I'll just tell you, when you're thinking about foreign investments, right? These are the questions to kind of run through your mind as you're planning it with, your financial planner, or if you're doing investments yourself. Is the first question is, where are your investments regulated, right? it is possible to have foreign investments that are regulated in the US, but the main thing is, where is it regulated? Is it regulated by the US, AKA, do you get a 1099 form, right? If your investments will result in you having some type of 1099, 1099 int, 1099B, 1099 div, that's an automatic kind of way to know that that's regulated by the US and it's reported normally on your tax return as interest, dividends, or capital gains. If you make an investment that will not issue a 1099 form because it's regulated by a foreign market and they don't adhere to this type of reporting, then you have to jump to the next question is it kind of a pooled fund? So pooled fund is a very general term, but essentially are you investing in a single stock of a company, right? So are you buying Google stock? Are you buying Apple stock, where you're just purchasing the stock of this active company, which, in terms of active meaning, they actively make their revenue by performing some type of service? Or are you buying into a mutual fund or an ETF or something that's essentially a lot of different stocks pulled together, or a lot of different things pulled together into one fund that you can easily access? And if it is a pooled fund, then you do have to jump to the next question is this a PFIF, a passive foreign investment company? And if it's a PFIF, basically, this does make your US tax reporting a bit more complicated. So when it comes to foreign investments, that's the biggest thing to worry about, so to say, is, are you investing in a PFIF? PFIFs are not terrible. I don't say stay away from them forever. I just say be aware that if you do invest in PFIFs, you have to understand that you probably need Form 8621, which is normally an expensive form to file, right? There's extra preparation costs to it. So you have to factor that in to your planning. And then on top of that, there's usually quite some tax that can be allocated to these type of funds, right? So additional tax that is calculated on it. So just be aware of that, that they're not as straightforward as making, US regulated investments and or investing in single stock holdings, things like that. So with that being said, David, if you have anything to kind of shine light onto a bit more for foreign investments, please do let us know.
Yeah, thank you, Nathalie. That's a really good point to start on, talking about the different questions or classifications of investment types. The point you made was really important and correct, that the passive foreign investment company structures aren't illegal per se. They're just punitive to make it rather unattractive. So it creates that broader question you have to ask yourself as an investor of what are you trying to achieve when you're managing your money and your investments, and what is the best way for you to get there. And if it is through one of those structures, you understand that the taxes may be higher, the cost of reporting will certainly be higher, and the opportunity cost is investing in something else, that whether that's a QEF, they love acronyms in this space, don't they? A QEF, a qualifying election fund, or if it is a US regulated investment that can produce a 1099, as you say, or direct stocks perhaps. So understanding what is that best course of action to help you to achieve your goals. And that is a really important point. The other thing to say, I think, linking what you were talking about with banks before is, and some of the investment institutions, is that many of these PFIFs in Europe that are otherwise regulated and approved and acceptable investment structures may not take you if you're US connected. So they may make the decision for you because it reduces their risk just by saying no to all US connected people.
All right,
I'll
perfect.
pass it back to you now.
Perfect. Thank you, David. So let me get back to my slides. All right. But yeah, as David said, I don't touch on it too much in here, but again, PFIFs aren't amazing, but they're not terrible. With proper planning, as with everything, they are doable. So as David already kind of threw out a few acronyms, things to be aware of, and I don't go into it in this presentation, but if you do invest in a PFIF, it's not over, right? You can obviously plan. There are 3 different elections. There's a QEF, there's mark to market, and then there's a default election, which is 1291. Basically, QEF, those are the nice ones. So if you find a PFIF, it says it's QEF, just kind of think of it as this will be treated pretty much like a regular, US investment. So say on your tax return, you still need 8621, but taxation wise, it's pretty good. Then obviously, if you don't have that possibility, if you plan in advance, basically before you make the foreign investments, just talk to whoever is doing your taxes for you, or if you're doing your taxes yourself, be aware that in the first year you purchase a PFIP, that is the most optimal time to file 8621 to make the mark-to-market election so that you can have a more favorable tax treatment. So again, main story here is plan a little bit, don't just blindly invest, but know what you're investing in, know what you're getting into, and know that there's always a strategy out there to make sure that it's a little bit more optimal. So now we jump into foreign pensions. I call out more employer pensions because that's the norm, so to say. There are basically three things to know about a pension, right? The first part of a pension is obviously the contributions. When you first have a pension, you're contributing to your pension. You're not necessarily taking anything out. So when you contribute to your pension, something that you need to understand on a US tax return is actually contributions are taxable. Employer contributions are taxable in the year contributed. They are seen as additional salary, additional compensation. So if you have an employer contribution, or if you have an employer pension and your employer actively contributes to your pension, technically you should be reporting that amount of contributions your employer makes on your US tax return in addition to the wages you make from that employer. Now, as we're focused in Germany and Netherlands, actually these are 2 countries, 2 out of 5 countries that have a very special tax treaty benefit saying that you can defer the treatment of employer contributions. So basically, to sum it up, generally, you have to report employer contributions. However, in Germany and Netherlands, because of the tax treaty, you can defer them, so to say, so you don't have to worry about reporting it immediately. The only thing to remember is if you make the decision to defer them via the tax treaty, you still have to file Form 8833. And Form 8833 is essentially just a disclosure on your tax return that says, I am using this tax treaty benefit. This is the article number, this is what I'm doing with it, et cetera, et cetera. So this form does state at the top that there's a $1,000 penalty if you take a tax treaty benefit and you don't disclose it. I have never seen this penalty enforced. However, I have to call out that it is an important form to not miss. The next part is obviously distributions. One day you will draw from your pension. One day you will get income from your pension, right? That's the whole point. You put money in, the money will ideally grow, and then you'll be able to pull out that money. Now, when you pull out that money, please keep in mind that pension distributions are pretty much always taxable in both countries. So if you have a German pension, that should normally be taxable in Germany and also taxable in the US. However, what you can do is any taxes paid in Germany, you can use as foreign tax credit on your US tax return. This can be a bit of a controversial topic because if you read any tax treaty, at face value, there's usually a whole section about pension distributions, and it will normally say that pension distributions are only taxable in the country of residence. So, you being a US expat in Germany, you would just read that as my pension distributions from my German, employer is only taxable in Germany. However, please keep in mind that every single US tax treaty has something that's called a savings clause. And if you read into what a savings clause is and you read into the specific saving clause for each treaty, you will realize that pretty much 99% of every tax treaty is not applicable to you as a US citizen. I know, bummer, but that's the reality of it. And normally pension distributions are included in that 99% that's not applicable to a US citizen. I think there's about 1 country that actually allows you to use the tax treaty treatment on pension distributions. However, that is definitely not Germany or Netherlands. So keep that in mind. Again, you can normally use foreign tax credit. So don't feel that, now you're going to get double tax. You should not be double taxed on pension distributions. So another thing to keep in mind is there are other reporting requirements. Pensions do get a little bit tricky. The first one, that's the tricky part, is if your pension is considered a foreign trust. That is basically reported on Form 3520, 3520A. Good news is pretty much any standard employer-employee pension should be exempt from this reporting requirement, which is amazing. It's this new revenue procedure. It's not that new, but in 2020, it came out 2017. And it basically says that as long as your employer-employee pension, scheme is basically tax favorable. So to say your contributions are either deferred locally or they're taxed at a lower rate, et cetera, you don't have to report them as a foreign trust. So it's exempt from reporting. So that covers pretty much any standard employer-employee pension scheme. So don't worry about that. However, if you decide to invest in a private pension, you do have to look out for this, because most private pensions are not exempt just because of the way they're set up. In terms of not being able to hit off that checklist that Revenue Procedure 2017 has that allows you to exempt it from foreign trust reporting. Foreign trust reporting is quite complex. The forms itself have $10,000 penalties each, which are very much enforced from the IRS. I think this is probably the biggest late filing penalty that is enforced by the IRS. So because of that, they are very pricey to prepare from the tax preparation side. They're very confusing to prepare. So just, again, if you make that type of investment, be aware of the additional preparation fees you'll have to pay every single year to hold that investment, so to say. And obviously, if you have like a social security pension, these are normally completely exempt because they're not seen as foreign trusts. So that is about foreign pensions. David, if you have anything to add there.
Yeah, I think the pension system can be deceptively complex when you're an expat in the Netherlands or Germany. And we usually start with the difficult question, asking a client where they see themselves in the future, because that can determine how you engage with that local pension system. If you think you're going to be there for 3 or 5 years and moving on, you'll have a different approach to if you see yourself there forever. And the aspect, of course, is that people that retire to a third country, so they built up US pension assets, built up perhaps German pension assets, and then go and retire in Portugal. And then we're juggling with 3 tax systems potentially in 2 currencies, managing pensions. But you do need to be aware of those differences in both Germany and the Netherlands. It's a 3-pillar system. So you have that state-based pension, as you mentioned. The access to that can be quite different and different from the US. And later, in the Netherlands, for example, the AOV is going up from age 67 to age 70. So if you're planning to stop work at age 60, you've got a gap to fill potentially. In the Netherlands, there's an employer pension. You can add to that with a personal pension if you like. And again, there's currently no access to capital. So that's something you really need to think about if you're adding extra amounts to that. It's doing what a pension is set out to do in the pure sense, and that is provide income for your future. But it's a different context perhaps to how you might look at a Roth IRA, where you do have potential access to capital back in the US. In Germany, you have different systems with different tax benefits, like a RUROP or Basisrente, where you can potentially, if you're a high income earner or self-employed there may be an opportunity to get rather attractive tax deductions on that, and your local tax advisor can advise you on that. But besides that, the Reisterrente and the personal pension alongside your employer pension can provide a pretty comprehensive service. You need to be conscious of how they're considered in view of the IRS and the US tax system, in the sense of, are they considered pensions or are they otherwise taxable like an otherwise held asset? So there's a lot of complexities that need some careful consideration and perhaps some good advice before you dive straight in. Speaking to the guys at MyExpatTaxes, a good idea, or us at a more strategic or Black Swan Capital.
Perfect. Thank you, David. And yeah, it's always kind of this, I think what it says when it comes to planning, remember that at the tax side, when you actually get to your tax return, it's no longer proactive, so to say. It's more reactive. So usually when we get to the tax part, it's hopefully trying not to fix anything that's happened, but more, make them optimal. So it's always a good idea to get some proactive advice before you end up at the tax prep stage and say, but I made these investments already. And then, you'll have us kind of trying to think, okay, well, how do we try to make this as optimal as possible, because it's already happened. With that being said, when you do file your tax return, you're going to see a lot of different forms, especially as an expat, right? It's very common for expat tax packages to be anywhere from 50 pages to more. What I want you to know is that you shouldn't get lost in all the different forms and worksheets and disclosures that are needed. These are kind of the main forms to focus on, right? And of course, this is recorded, so you'll have this, so no need to like screenshot anything. But really the main thing to know is Form 1040 is your overview form, right? This is how much income you make, what deductions are you taking, what credits are you taking, what's your refund, what's your owed amount. There's going to be a couple schedules attached to 1040. I just tell a little funny story of, a certain presidential campaign that said that they would make a tax return the size of a postcard to make it easier for everyone. And what actually happened from there is they took the original 1040 form, which was 2 pages. They like cut it up into like postcard sizes, and then they attached 6 schedules to it. So it went from 2 full pages to like, 6, 7 half pages of returns. And then from there, they've just been snowballing it where it's now not even half pages anymore. It's just, if you've seen the latest version for 2022, there's like 10 different lines just report wages. So it gets a little confusing, but keep in mind, 1040 is an overview form. That's what you should focus on. Anything that has 1040 schedule, et cetera, is just additional information to your 1040. If you have children and you're claiming the additional child tax credit, you should look for Schedule 8812. That's how you get that, expat refund that a lot of people love of up to $1,500 per qualifying child in 2022. And obviously the main tax forms that you might be seeing in your tax return is 2555. That's the foreign earned income exclusion. That's the one where you can exclude, over 100K of foreign earned income from US taxation. There's 1116, which is the foreign tax credit form, right? That's the one where you claim any local taxes paid on your US tax return. And as I mentioned before, 8833 is the one where you claim tax treaty benefits, and obviously FBAR and Form 8938, which I talked about as well. So these are really the main forms to focus on and make sure that, they're included correctly and you're using them on your US tax return. So with that being said, there's really 3 main expat tax benefits to be aware of. So, there's the foreign earned income exclusion, there's foreign tax credit, and there's tax treaties. This is an overview, obviously, from my own personal perspective of, what it is, how difficult they are to use, and what's the pros and cons. So for foreign earned income exclusion, this is the most standard expat tax benefit. I think pretty much this is the most common way to go if you go to any firm or tax software. It's pretty easy to use, especially if you live abroad for more than a year, and it's great for low income, like low tax countries, because you don't need foreign tax credit, right? Even if you don't pay a single dollar in foreign taxes, you can use the foreign earned income exclusion and basically exclude up to, over 100K of foreign earned income from US taxation. Now, obviously, the key is in the name, foreign earned income, and that's why I keep repeating it, because the income you exclude on this form, 2555, must be foreign, and income is sourced at this level. Income is sourced based on where you work. So say that you have a German employer, you work mostly in Germany, but they send you to work in the US 1 month out of the year. Just keep in mind that 1 month that you work out of the US, any income you earn during that 1 month is not considered foreign income. That's considered US income because you physically work in the US, but the other 11 months is considered foreign because you worked outside the US. This goes in the other direction as well. You work for an American employer, you get issued a W-2, but you work from Germany. If you work the entire year from Germany, you don't enter foot into the US at all. All of that income is considered foreign. So you can actually exclude that on 2555. The other part of this is it must be earned. Earned income is normally salary, self-employment, active partnership income, business income that's active. Again, basically you have to physically do some type of service to earn this income. It's not investment income, it's not pension income, it's not social security benefits. So that is the foreign earned income exclusion. Now, when you use it, things that are not great about it is you can't claim the additional child tax credit. So I mentioned this a lot. It's the form 8812. It is a very prized refund as an expat. If you have children under the age of 17 in 2022 and they have a valid US Social Security number, and you are making over 2,500 US dollars and you're paying taxes where you live, a good amount of taxes where you live, you should be expecting about $1,500 as a refund on your tax return per qualifying child. But if you use 2555, you can kiss those refunds goodbye because that will automatically disqualify you from that refund, even if you're technically eligible for it. The other thing to mention is if you use the foreign earned income exclusion, what that will essentially do is get rid of your taxable compensation. So if you want to contribute to a Roth IRA, like David mentioned, or any type of IRA, that's something you have to watch out for. If you make 100K of income, you exclude 100K of income with the foreign earned income exclusion, you have zero taxable compensation. So you cannot contribute to an IRA. And the other part is once you use the foreign earned income exclusion, you actually should continue to use it, because the minute you switch and you don't use it anymore when you should, you have to basically revoke it for 5 years and you can't touch it again for 5 years. So once you start, it's a little bit hard to stop, so to say. And that's why at MyExpatTaxes, we actually always try to start with the foreign tax credit if it's applicable for you and it works for you, just because that is a lot more of a flexible approach. So obviously, the foreign tax credit, which you report on 1116, it uses income taxes paid in Germany, in the Netherlands to offset US taxes owed. It is a difficult form to file because if you look at the form itself, it's pure math. It is 2 pages of pure math. And on top of that, there are different buckets of foreign tax credits. So you'll see at the top of every 1116 form, there's about 8 different buckets. You have to figure out, if your foreign taxes falls into the general category, the passive category, the resource by treaty category. I could go on, I will not. And then on top of that, there's an alternative minimum tax version calculation for each. So if you use 1116, you can expect to see anywhere upwards of 6 versions of 1116 just to calculate some foreign tax credits. So a lot of math can be difficult. If you're an Excel whiz and you do it yourself, kudos to you. But I think most people would prefer to have someone do it for them. What is great about the foreign tax credit is you can claim the additional child tax credit, right? It makes you eligible to get that refund, and it doesn't take away any of your taxable compensation. So if you have, foreign income and it's just foreign wages, you could technically still contribute to an IRA if you use the foreign tax credit. Obviously, be aware of the other requirements to contribute, such as, your adjusted gross income or things like that. However, generally, this is a lot more flexible for expats that want to contribute. Like I said, it's complex. And obviously, if you don't pay a lot of foreign tax credit, this just doesn't work for you because there's no credit to claim. Then the next one is a tax treaty. As I mentioned, there's a lot of different tax treaties. They can be very beneficial for certain income items, such as Social Security benefits, where you can't use the foreign earned income exclusion, and most countries don't tax Social Security benefits or any type of state kind of benefit you get. And that's where the tax treaty comes into play. So even though there's a savings clause, which basically invalidates 99% of that tax treaty for you as a US citizen, the 1% that's still valid normally is around kind of Social Security payments, so to say. And so this is where that becomes very useful to say, okay, this Social Security payment I get from Germany is actually not taxable at all in the US. Obviously difficult because you have to understand the tax treaty, you have to understand the savings clause and how to claim that on Form 8833. But it's an amazing one to use because you can basically just say this income's not taxable at all. So as you're wondering how to use all of this, can you use all 3 at once? You can. Can you just use one at a time? You can, right? MyExpatTaxes will actually determine what's the best one for you based on your refund or taxes owed amount. If there's a tax treaty applicable, we'll automatically stick it in for you in your tax return. So, something to consider as you're planning your taxes for this year. Alrighty. So now that we're talking about taxes for this year, here are the deadlines on the screen. So just keep in mind that, it's always April 15th, unless that falls on a weekend or holiday, which it does again this year. So it's April 18th. For any expat that thinks that they owe taxes, stick to April 18th. That is the deadline for payments. However, if you don't think that you'll owe taxes or you think you'll get a refund, you don't really have to worry until June 15th. So that's your filing deadline. Expats always get an automatic 2-month extension, keeping in mind that it may be automatic, but again, you do have to include a certain disclosure on your tax return. So most tax softwares that are US-based will forget that. But it is technically an automatic extension because you don't have to apply for anything. You're granted it if you are an expat. The only thing is it's only for filing. So if you owe taxes, you still have to pay by April 18th, right? You don't have to file till June 15th, but you have to pay by April 18th. So it's a bit of a chicken and egg situation. I just say if you have a lot of US source income, if you're used to paying US taxes, you're just kind of worried you don't know, stick to April 18th. You can obviously do MyExpatTaxes. You don't have to even pay, but before you get to the very end, before you pay, you'll actually see what your estimated refund or taxes owed. You can use that to gauge if you need to kind of watch out for April 18th, or you can wait till June 15th. You can also file for an extension. right? Again, extensions are only to file, not to pay, but you can get a filing extension with Form 4868. So you can either e-file the extension with a tax software, you can pay $1 via irs.gov /payments for the extension payment, and you can get an extension till October 16th. And obviously, if you have back taxes, you want to do that as soon as possible, because if you do owe taxes, interest and penalties are accruing every single day. With that being said, I don't have a slide specifically for it, but again, back taxes, if you haven't been filing for a while, there's always a streamlined filing procedure, which we support at MyExpatTaxes. So that's an option for people that haven't been filing for a lot of years that have to get into compliance. Now I go into what's changed for 2023, right, for your 2022 tax return. So first thing is standard deduction increases about $400 per taxpayer. This is pretty awesome for, anyone, especially that's looking to kind of optimize their tax return in the sense of using maybe the foreign earned income exclusion and then having investment income so that you can actually pull out up to, $12,950 of investment income tax-free. I don't get too much into it, but I'm just saying that's a strategy as well. Everything has a strategy involved. It's actually very fascinating. Tax brackets do increase, even though the rates stay the same. That just means that if you are ending up paying taxes, that, more of your money will be taxed at a lower rate than a higher rate. So it is beneficial for you. Obviously, the foreign earned income exclusion does increase due to inflation. So it was, 109K about last year. Now it's 112K. And then, big news too is if you're getting the additional child tax credit, it is increased from 1,400, which everyone is used to 1,500. So that's per qualifying child. And then things to say goodbye to, which is a little bit sad, but the first one is above the line charitable contributions. So if you had contributed to a charity, you could have actually taken up to $300 or $600 based on your filing status in addition to the standard deduction. You can't do that anymore. So you can only itemize your deductions if you want to claim charitable contributions. There's no more stimulus payments. That was only in 2020 and 2021. So there's no stimulus payments in 2022. Obviously, if you haven't filed your taxes for 2020 or 2021, you can still back claim your stimulus payments for those years, but there's no stimulus payment to claim in 2022. And for those that are living in the US, in terms of you're living in the US for more than half the year, you will be sad to see that a lot of the child-related refunds that you had last year, which were very high, up to $3,600 per child, that's all gone. So, obviously most expats, you won't notice a difference on that one, but anyone that's mostly in the US, a little bit abroad, you can say goodbye to those as well. So that ends pretty much my big overview. Obviously, again, if you're looking for any, tax solution, MyExpatTaxes is there for you. I don't have to say anything more. I think I have explained it enough. And if you have, more tax questions that are not answered, we'll do a Q&A shortly that Anya will moderate. But if you have tax questions that aren't answered, you can always join our Facebook group. It's a very lively group now. And most of the questions, if they're not answered in the group itself, will actually be forwarded to me or, one of my senior preparers, such as Migle, who's also on this call, which I forgot to introduce in the beginning, and I'm very sorry about. But Migle, whenever you want to turn your camera and just wave, you can. She's one of our senior pairs. We are the ones that are actually answering the questions. So that's a great way to get in contact with us. So I will stop sharing now and give it back to Anya and, just tell us how to handle the Q&A.
Absolutely. Thank you so much, Nathalie and David. Absolutely excellent presentation. Very, very informative. And we certainly have quite a few questions from the audience. So we'll move to the Q&A session right now. Please feel free to continue to ask those questions as we go through them. We'll just start at the very beginning. Someone who is a young expat looking to start investing soon is asking, is it easier, more beneficial, less paperwork to invest via European institutions or American ones? He or she says, as I understand it, there are additional forms for foreign investment accounts, so I'm inclined to use American account, but I'm not sure if that has an effect on my taxes in the Netherlands. So maybe, David, do you want to tackle that one first?
Yeah, I can. Thank you for that. And thanks for the question. There's a few it depends caveats in this, and I'll go through most of those. So starting at the end about the tax, and my caveat to that is that at Black Swan Capital, we're not tax advisors, we're financial planning investment advisors for expats. However, if you are on the 30% ruling, which makes sense. If you're living in the Netherlands, you understand that there's a slight tax deduction, but there's also the case that you don't necessarily have to lodge what we call here box 3 wealth tax. Taking a step back, in Germany, like many countries, you have capital gains tax. There's no capital gains tax in the Netherlands, but there is a wealth tax. And you do that once a year on your worldwide assets. So that would mean if you are in the Netherlands and you weren't on the 30% ruling, it doesn't matter where your assets are held in the world, you're still reporting it in the Netherlands as your worldwide assets for wealth tax if it's above the threshold, which is about 57,000 for 2023 for an individual. So that's the first point. So are you or are you not on the 30% ruling? If you're on the 30% ruling, you're not submitting that anyway. In terms of where you're investing, then it comes down a lot to a whole lot of factors such as currency, opportunity, being allowed to invest there, and your objectives and where you see yourself. We know that there's this gray area around can you or can you not invest in the US from living in Europe. Many institutions now will not accept individuals going back to their own brokerage. And we had 2 cases earlier today of clients saying they had the dreaded letter from their institution saying, we understand you're now living outside the US and would you please close your account? It's not necessarily because it's illegal, it's because it's too hard. And as Nathalie was describing before, there are rather high punitive fines for institutions to get reporting wrong. So it's easiest just to exclude you. That is the first obstacle you come up against. One rebuttal we hear against that is, what if I use an address in the US? We typically say, no, that equals tax fraud, according to the definitions. Other people have a more liberal view of that. And again, we're not the tax advisors. Be careful is all I would suggest, and think about the worst possible case scenario of your actions, and then go from there. It is absolutely possible as a US connected person to manage a global portfolio of assets in multiple currencies in the US, in Europe, without unnecessary or undue costs, comparative cost to the US, without any other restrictions around liquidity or flexibility either. So you can do it. It's just a matter of, I guess, knowing where and how to go to do that. So it sounds a little long-winded, but I hope that's an answer to the question.
That's an excellent answer. We like detailed answers, David. So thank you so much for covering that one in good detail. Shifting gears a little bit, Veronique is asking, she's a Belgian citizen and a US resident. If she retires in Belgium, will her US Social Security be taxed in Belgium?
So it will depend on the tax treaty with Belgium. So I don't have that, on hand, and I can't read it to you. But really, to look at that tax treaty, and usually there will be a section that says where Social Security payments are taxable. So there's really 2 ways Social Security payments are taxable. It's either taxed by the paying country or it's taxed by the resident country. So if the Belgian and US tax treaty says it's taxed by the paying country, then you can expect the US to still tax your US Social Security benefits, and Belgium would not. If it says that it's taxed by the resident country, then that means Belgium will be taxing your US Social Security benefits and not the US. So normally there will be a specified article to say who taxes Social Security benefits, and usually Social Security benefit articles are exempt from the tax treaty. So that means you can use it as a US citizen. So sorry, I can't give you the specific answer. Obviously, if you go through MyExpatTaxes or you go through my team, we will look at your tax return in general and make sure we have the right election. But if you're doing it yourself, just look at the Belgian US tax treaty, look for the article on Social Security payments, and then from there, basically look for the key terms. Is it taxed by the paying country or taxed by the resident country?
Certainly. Thank you, Nathalie. We know that these tax treaties are not the most interesting to read, but they do provide those kinds of answers, most definitely. Excellent. So Nathalie, another question for you from Lily, who says, my US tax advisor is worried that if I contribute to a basis rente pension plan in Germany, she is a US citizen only, it would be considered a PFIC. Are you aware of any legal precedent that would give her comfort, I'm assuming the accountant, her comfort that those contributions would not be considered a PFIC?
So it's not necessarily about the contributions, it's about what's laying in, that pension. I think David can probably step in a bit more for the specific of this pension in Germany. However, when you're thinking about a PFIC, it's about what lays in that pension. If your pension has, different pooled funds in it. So basically what you do is you look at the pension and you look at what is the pension invested in. If you see that the pension is invested in, 3 different pooled funds, then most likely you'll trigger some type of PFIF reporting. Keeping in mind though, again, there's always exceptions to everything. Germany and Netherlands are very special countries. 2 out of 5 that are special countries, where there's actually an exception in the PFIF reporting that if this is considered kind of like an employer pension, so to say, that even if there's PFIFs in them, it won't trigger the PFIF reporting. So they're exempt because the tax treaty itself will, basically defer any income or benefits from that pension until distribution. And so then there's no PFIF reporting that year. So I know that's not a specific answer. David can probably jump in a bit more for that specific pension in Germany. However, again, it's not about the contributions, it's about what's underlying in the pension. And then on top of that, because you're in Germany, it depends on if that pension qualifies for the tax treaty benefit. And if so, then even if there are PFIFs, you don't actually have to do PFIF reporting.
Yeah, it's a good response in terms of what I can add. And you're right, it does depend on the underlying assets. Generally speaking, the Basisrente is qualifying as a pension because of its illiquidity status that meets the thresholds for pensions and therefore could be exempted. I would go back to checking with the pension provider who should know the answer to that question. There are some good pension specialists that can do with expats in Germany who can help you. They're most of these pension structures, as you know, are based around an insurance company model with underlying funds. So it depends on the structure of those underlying funds, as you say. I would be going to get more information before making more contributions there.
Yeah, you can definitely always email MyExpatTaxes, right? If you want to have really personal look into it. But I just add one more thing. Generally, like if it's a private pension, they probably won't get the tax treaty benefit. So if there's underlying assets that are pooled funds, it will most likely trigger PFIF reporting. If somehow it's kind of seen as an employer pension, then most likely you actually get to claim the tax treaty benefit. So even if there's PFIFs in it, you won't have to do PFIF reporting. So again, being in Germany, there's 2 different layers to it. The first one is just what's the underlying investments. That's something you need to understand, right? So you have to understand really what are you putting your money into. And if there's pooled funds in that, definitely there's PFIFs. However, in Germany, Netherlands, and 3 other countries, such as the UK, etc., you might be able to use a tax treaty benefit to get out of PFIF reporting completely.
Excellent. Thank you both for that answer. That actually took care of another question around the same topic. So thank you for being comprehensive on that. Switching gears to a more strictly a tax-related question, Elliot asks, if I file married filing separately, does my foreign spouse need to get an IRS-issued TIN, or no extra information for my spouse is necessary?
Absolutely not. So that's another reason I really hated the US-based tax softwares, because they try to get you to get an ITIN for your foreign spouse, and it's absolutely not necessary. You can e-file a tax return as married filing separately to a non-resident alien spouse, NRA, with absolutely no ITIN. We do it all the time, right? So if anyone ever tells you have to paper file because you're married to a non-US citizen, they're lying. You don't have to. You can e-file. You don't need to get them an ITIN. You can literally just write NRA as their name, right? Non-resident alien. The only thing to watch out for is when you do FBAR reporting, you do obviously have to report joint accounts if you have a joint account with your foreign spouse. And then on the FBAR reporting, they will ask for, the name of the joint owner. It's obviously up to you. There's no specific clear rules around it. Some people still just write NRA as the spouse's name and leave it at that. Some people will write out, their full name. So up to you in that regard. But basically, no, you don't have to include anything from them. Just on the FBAR, you have to include joint bank accounts.
Excellent. And along the same lines, Nathalie, somebody asked if it's possible to e-file through MyExpatTaxes if my spouse is a non-resident alien. I think you just answered that.
Yes,
but is it possible
absolutely,
to
yes.
Yes, and backfile as well, right?
Exactly. So if you're backfiling, just keep in mind. So if you're just backfiling, you can The IRS only allows you to e-file basically 3 years at a time. So right now you can e-file 2020, 2021, and 2022. So if you're backfiling to 2019, you just cannot e-file 2019 anymore. It's out of scope. If you're streamlining, right? So basically you haven't been filing for 3+ years, you have to get into compliance. If you're streamlining, all streamlined returns always have to be paper mailed. That's just part of the rules, because there's an IRS agent that looks at every streamlining certification to see if you qualify for streamlining or not. That will always be paper mailed, but unless you fall into basically it's a very old return or you're streamlining, you can always e-file.
Excellent. Thank you so much. Another question here, tax related, but also FBAR related. For a married couple, do we file FBAR only if our accounts reach 20K euros?
10,000. So married filing jointly, single, 10,000 is the max. Keep in mind, it's not about each account reaching 10,000 USD, not euros, right? USD. It's about the maximum balance of all foreign financial accounts across both of you if the combined max balances is over 10,000. And if so, you must report every single foreign financial account that you have, even if those accounts might have $0 on it on your FBAR. So just a good example of that is if you have two bank accounts based in the Netherlands, and say you have 5,000 euros in bank account number one, and then for some reason you transfer the full balance to bank account number two in the same year. Well, if you look at it, you have a max balance of 5,000 in bank account number one and a max balance of 5,000 euros in bank account number two. It might be the same 5,000 euros, but you have two max balances of 5,000. And if you add that together, you have 10,000 euros as a max balance, and then you convert that to USD, and euros is typically more than USD. Let's see how that continues. But then you have over 10,000 USD, and you have to report both bank accounts on your FBAR, even though each one did not actually reach 10,000. That's pretty confusing. I know, it's just the way the FBAR is set up. That's simply it. If you're ever unsure, I just recommend to file the FBAR. There's a $10,000 penalty if you don't, but if you file it, it's purely informational. It's definitely intrusive, right? But keep in mind, your banks abroad are already sending that information. So, there is no privacy at that point anyways. It's definitely intrusive and obviously a bit of a pain to file, but it's not worth it to one day get a $10,000 penalty just because you were a little bit over the threshold and you didn't realize it.
Excellent. Thank you for that. Now we've got just a couple minutes left and lots of questions to go through still. We'll try to touch on as many as possible. And of course, we'll have your contact information and a follow-up after this so that we can get to all the questions, but really interesting ones. Here's one from Elliot about how is self-employed defined from the US side versus the German side. Specifically in 2022, Elliot taught a seminar for a German university and got assigned what I'm not going to try to pronounce, a self-employer, he said, tax number from Germany. Does this mean that this income is also counted as income from self-employment from the US point of view?
So generally, if your local country sees it as self-employment, it's definitely self-employment from the US side, right? It's one of those. So when it comes to self-employment income, I think the main thing to look at is the common law employee principle. So basically, if you work for the same employer and they fix your hours, they give you, your laptop to work with, they control your work schedule, what you're working on, your projects, then even if you're considered self-employed where you locally are, you could still be actually an employee, a common law employee per IRS regulations. So I would just recommend you look at common law employee as, if you Google that IRS, you'll find the whole article about what constitutes a common law employee. But generally, if they're doing this one time and you wouldn't consider that this university is controlling your ability to work and how you plan your work and things like that, it's probably self-employment income.
Absolutely. And let's take two more questions given our time constraints, but one is pretty quick and easy, I think. Does fintech like Wise count for FBAR?
So this is a little bit gray area, I would say, these online accounts. I just tend to go conservative. It's based on kind of what is the subsidy, so to say, that you sign up for. So if you sign up for Wise, but you have like a US bank account, that's, most likely a US account. But if you go for Wise and you have, a type of European account, so it's like a German account or a Netherlands account, that's considered foreign. I mean, the same goes for PayPal accounts, right? If you sign up for PayPal UK versus PayPal US, et cetera, et cetera. So again, I go more conservative because it's just not worth it at that point if you're filing an FBAR anyways. Some things to note is obviously sometimes you don't have an account number, like with PayPal, use your email, right, as the account number, some type of identifier. On the FBAR, it's just do your best to fill it out. So if there's any questions, you can say, I did my part, right? I tried to fill it out to the best of my ability. So the IRS or the US Treasury can never say that you tried to omit information.
Thank you. And lastly, to conclude, any way to check that the IRS received filing from past years? This is a question from Liz.
Easiest ways to call them. There's an IRS international hotline. You can call them. Right now, there's actually not huge waiting times. Last year, it was impossible to reach them. Now it's a little bit easier. Call them, tell them your name, social security number, and they'll tell you what they have on file. You can always try to check your online transcripts if you can get in. They fixed the way that ID.me works, which is the way that you can get an online profile with the IRS. So actually, there's a way to go through kind of this trusted referral program, which basically means that you have a video call with someone and then you show your passport and your social security number. I did that myself. So even if you're an expat, you can now actually get an online IRS account, which means you can check your transcripts. So easiest way, I would say, if you don't want to go through the hassle of going through ID.me, call them. Obviously, then you have waiting times. Otherwise, if you want a more permanent solution, just try to create an IRS online account, go through ID.me, look for the trusted referee or referral reference program, something like that. I'm not 100% familiar, but you will have an option to do a video call and authenticate yourself. And then that will be another way to check your status.
Excellent. So definitely do file your taxes. And again, thank you so much for excellent questions, everyone. I know we didn't get to all of them. However, we'll be sending a follow-up. If your question has not been answered or you'd like to get in touch, feel free to contact us over email. We'll be sending out the follow-up message with this recorded session, a copy of the webinar, and contact information for our guests. So again, Nathalie and David, thank you so much for being here today. Really great information. And thank you everyone for attending. Have a great afternoon.
Thank you, everyone. Bye-bye.
Thank you very much. Bye.